Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news? It only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey everybody, we are on the stretch here for Investing Unscripted. Welcome back. I'm Jason Hall. He is Jeff Santoro, the voice of the people, and we're doing our last Q&A for the year. It's our last mailbag, Jeff.
Last mailbag, last couple shows of 2024. We got some fun stuff planned for the rest of the month, but this is our last chance to answer listener questions or respond to listener comments. We get some comments, not always questions. I got to be honest, Jason, a little bit of a light mailbag. I'm going to give our listeners a pass here. It's a busy time of year. You know, holiday, people doing shopping, busy with events and things. But yeah, I expect
it's also kind of close. It's also kind of close to our the live stream, the first Friday. So we get a lot of people that come on to ask questions for that.
This is a one-time pass, though. I'm expecting our listeners to step it up in 2025 and inundate us with questions.
Yeah. Yeah, that might be our motto for 2025, where the listeners step it up. You guys need to be doing
We're working way too hard here as the people
all the work here
who talk.
You know? Yeah.
Please do our job for us.
So we do have some good questions. So we've got some good comments we're going to respond to. But we're also, that actually kind of worked out that it was a little bit lighter because we're also going to unveil our plans for the 2025 Investing Unscripted Portfolio Contest.
Yes, this is the third year we're running a contest. Each year has been different. Next year will be no different than that. It'll be something a little bit, a modification that we think is an improvement. Maybe when we finally feel like we've settled on the right contest, we'll keep it the same. But it's been a couple of years of experimenting with different ideas. So yeah, we'll answer some questions, respond to some comments, have some fun, and then explain what our contest will be, because it will be open to listeners. So you're going to want to hear the deal, pay attention to the deadlines, and be involved with us.
Foreshadowing, we have been doing a stock picking contest and calling it a portfolio contest. We're actually going to be doing a portfolio contest going forward. You'll hear more about that at the end of the show. Jeff, before we get into the Q&A, I just want to remind people about our Savvy Trader. I want to encourage people to go check that out, especially right now where the market seems really fully valued, a lot of momentum driving stocks. You and I have talked a lot about, it feels like maybe harder to find good valuation or good value for investing, something that we've been facing in that, but we continue to find a way through, and it might be a good opportunity to help kind of jumpstart some of those thoughts. And as good as the market's been, the portfolio has done even better since we launched it in April. So I'd love to see some more people get involved in that.
Yeah, I'd love that too. And it's all right. So I'm going to go rogue here a little bit, Jason. I'm going to ask you a mailbag question that I just came up with based on what you just said.
This is fantastic.
I was actually going to text you today because I feel for the last couple months, I have felt almost no desire, or I have not been compelled to do my normal like monthly buying of stocks.
In your personal real world.
In my personal,
money.
And this is, the continuing evolution of me as an investor, where I went from, I couldn't wait to buy stuff. I would buy stuff every single day, just $5 here, $10 there. And then I got to like a rhythm of every week. And then I got to a rhythm of every other week. And now here's an example. Today I was having lunch at work, opened up my portfolio, and I was like, I haven't bought anything in December yet. And I have my money sitting there ready that's been transferred over. And I opened my spreadsheet and I looked around and I was like, nah, I couldn't And I don't know if that's just patience setting in and me feeling like I don't need to be in a rush to do anything, but I think it's more that the market feels overvalued. When I look at my stocks, and they've done well because the market's done well, I don't see any compelling value. And I wonder if we were in a bear market and every day was red and all my stocks were down, would I feel differently? Would I be more eager to buy? Because I would feel like things are being offered at a discount, whereas right now it feels like I'm overpaying. So I'm curious. I mean, you're not a regular buyer either. You're sort of a raccoon on meth. So I'm curious, have you felt any differently?
I get very aggressive for short bursts, and then I spend days and days asleep in the knothole, I guess.
Well, because I think this is my first time going through like a prolonged, whatever you want to call it, exuberant, frothy market where I wasn't new enough to be just like wide-eyed and excited about it. Like I spent all of 2020, well, the second half of 2020 and all of 2021 excited and buying at what I now realize were ridiculous valuations.
Yeah.
And then we had the long downturn, and now we were on this long upswing again. And I'm feeling very zen about it, but also patient. So I'm just curious if you have felt any differently, let's say over the past year of, this year of 2024 compared to, I don't know, other times when the market's done well.
Yeah, I mean, compared to where I was, a year ago and earlier this year, definitely feels like I think there's still opportunity. There's still pockets where you can buy really good companies for decent valuations. But by and large, the biggest winners in my portfolio, I'm not compelled to add to them right now. Right. I think that's the key.
Same thing. Yep.
And again, this is thinking about the short-term winners, right? The long-term winners, I'm not thinking about doing a bunch of selling or anything, but I don't feel compelled to deploy a lot of money into stocks. As a matter of fact, Jeff, I've been a net seller of stocks certainly over the past few weeks, but definitely, I think if you look back over the past couple of months. So just for example, today, as the day we're recording this on the 11th December, I fully exited my Zoom. I bought some Zoom earlier this year when it just was trading for almost single digit cash flow multiples. It just was too cheap for that quality of a business. And we've seen multiple expansion. The earnings really haven't changed. The earnings have gone up. They've gone up a little bit. Cash flows continue to be good, but there's still issues with growing their user count, particularly in the enterprise. They reclassified a lot of stuff about what they consider to be enterprise customers. So essentially their enterprise business has shrunk. And I just kind of got to the point, it's like, you know what? When it was cheap, it made sense to buy it, but the business I don't see any acceleration of traction. And they've talked about buying back stock, and there's actually 2% more shares outstanding than when they first rolled out the buyback plan. So they're not creating value there. I just made the decision to move on. And then other positions that I've exited, long-term losers, Teladoc Health, I sold out of. I exited StoneCo because I don't feel comfortable and confident in my ability to navigate and understand the banking environments in unregulated markets like in Brazil. That was a loser for me. Next decade was a bit of a winner for me, but I just think that whole liquefied natural gas area has gotten really, there's a lot of competition going on, and I'm not sure about the long-term supply. I exited Boston Omaha, Jeff.
Oh, you didn't tell me that. Interesting.
Well, I didn't fully exit. I exited in a couple of accounts. I still have a small position. I exited Asana. So I've kind of trimmed what I think are some weeds, and a lot of those have done relatively well over the past year or so, but I've just lost confidence in their ability, and I don't want to invest any more time to research those companies when I think there are other companies that the market's going to give me a better opportunity to invest in. Because the market has gone up so much, I want to increase my allocation into the bond ETFs that I've added to get those percentages back up. So a little bit of selling so that I can rebalance as we get to the end of the year. Yeah.
Yeah, I have a feeling I will, when I have some time off in a couple of weeks heading into the holidays, I'll probably, have the time where I won't be able to resist the urge.
Yeah.
That's usually when I get more active, is when have a day where I can just sort of think about stocks and do some writing and things like that. So I don't know. What you said about the savvy trader portfolio triggered my thinking on that. So I wanted to see if you felt similarly to how I have. And it seems like, at least in terms of not being compelled to add to your biggest winners, which is how you put it, I feel like that's kind of where I am too.
What I have started to do before we get to our next question, just real quick, and this is a bit of a teaser. We have a guest that's going to be coming on in January that we're super duper excited about. Somebody that I think might be one of the best options investors out there. Holistically, an incredibly talented investor, but can be really somebody's going to help us talk about options a little bit. One of the things that I have been using is selling puts. So basically, I'm taking a premium and giving somebody else the right to force me to buy shares at a set price. But it's a price that I'm willing to pay, even if the stock falls below that, and I have to pay the higher price. It's a price that I'm comfortable paying. I've started thinking that that's a strategy that I want to use to create long positions more. Even if I don't get the stock at that price, I earn that premium. So it's a way to generate a little bit of something along the way.
Yeah, I've been selling covered calls a lot, and I feel like that could be part of the reason I'm a little bit less trigger happy, because I am doing something in the meantime. But yeah, we'll dive way more into that in January when we have that conversation.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. All right, let's dig into the mailbag here. The first question we got was from a friend of the show, Sina, who reached out to us and asked, and I thought this was a great question. I can't wait to talk about this. Do you ever feel simultaneously rich and poor? If so, what internal conversations do you have with yourself about it, and how do you discuss it with your wives?
I only have one wife.
Well, I think he meant the two of us, but
yeah.
Also speak for yourself.
Okay, fair.
It's fine. She doesn't listen. Neither of them do.
Yeah, no, of course. Absolutely. So this is good. Jeff, I want you to go first on this one.
I think about this a lot, and to me, it boils down to the whole, the balance between saving for the future and spending now. And I've talked about this a little bit in the past, but I think it's worth revisiting. So I'm a thrifty person kind of generally. Like I've always been careful to not spend more than I make. And if I've had conflict with my wife about things, it's around spending and just making sure that we have enough saved. But I've also changed the way I think about saving over the past several years, away from, I just need to make sure I have enough money for retirement and thinking about all these great things I'm going to do when I can retire, and more towards, I need to do some of those things now for a couple of reasons. One, tomorrow's not guaranteed, right? Not to be morbid about it, but there are, just in my close circle of friends and acquaintances at work, there's enough people who've shared stories of the person they know who retired and then died like 3 months later, right? And also, I have limited time where my kids are going to be around to do stuff with. Like I have a junior in high school and a seventh grader, and especially for the junior, I can't help but think, 2 years from now he'll be in college, and 4 years after that he could be living anywhere, working as a professional somewhere. So the chance to do things with my family, especially my kids, is now, not necessarily when I'm retired and they're off doing their own thing and don't want to hang out with their parents. So this is a long way of answering the question. I think about this a lot because I want to make sure I have enough in the future. I want to invest. I want to live comfortably. And I also want to force myself to do things now while I can and have the time to do it. So I do have this constant kind of tension between like cash flow and what's in my savings and retirement accounts, because I'm investing a lot right now because I'm trying to reach some goals and do a little bit of catch up, at least on my side of the house, for not investing as much as I should have from like age 21 through 40. So the nice thing is to Sina's question about the internal conversation I have with myself, the biggest one I have is this: I can turn the spigot of investing off, or at least turn it down, anytime I need to, right? So I'm probably over investing right now. Like if you sat down with a financial advisor and asked them, they'd probably be like, you don't need to invest quite this much, but we're able to do the things we want to do and get by and everything with me doing that. But if it ever got to a point where it was just too tight, too paycheck to paycheck feeling, I absolutely can dial that back. And all of a sudden I have a little more cash flow through my accounts, and then I'll feel a little richer, to Sina's way of framing this question. But I think for me, that's the way I think about it. When I look at like holistically, I feel rich. I mean, we are secure financially. Our future is in good shape. I don't mean that as a brag. It's just that I've worked hard to get there. But sometimes I do feel poor because I'm trying to save and therefore don't have as much immediate cash to do like stupid fun things. You know what I mean? Does that make sense?
Yeah, no, it absolutely does. It absolutely does. And I'm sure your wife feels poor simply because she's married to a teacher, but well,
it's not so much that, it's just she feels like she made poor choices, I think is the way she would frame it.
I was just setting you up to say that.
I appreciate it. I want to hear your answer, because your immediate response to this question, Sina sent it to us via text message, I believe was something along the lines of, no, I don't know what you're talking about because I'm too rich. So.
I have absolutely no way to relate to that whatsoever. No, it's, of course I was being glib and kind of a dick on purpose, but there actually is a little bit of a kernel of truth there. One of the things that we've done, and I think part of it is, Jeff, my wife and I are in our late 40s. We're the same age. So you can't call me very, very old anymore without also calling my wife very, very old. I'll let you deal with those consequences.
That's fine. I'm okay with that.
But we didn't have kids until we were 40 years old. We got married in our mid-20s. So, and we actually lived together for a few years before we got married. So we had a very, very long period of our lives. And for a long time, we didn't expect to have kids. It wasn't really until we got into our late 30s until we decided, okay, we want to have kids.
It took her that long to trust you?
She never trusted me. She doesn't need to trust me to have a kid with me.
I'm just trying to be mean enough that someone writes us and says that we should stop being so mean to each other.
I love reading those emails and then promptly ignoring them.
Yeah.
The point is, we had a couple decades almost of spending and traveling and experiencing and doing things, kind of building a certain amount of lifestyle that wasn't encumbered by the actual financial expense of kids. That was good. And at the same time, we found like financial like constraints, like the idea of pay yourself first. And also we're both high earners, so that helps. So there's always been enough disposable income where we were able to both build a lifestyle while also building wealth too, right? And so for me, because we've been pretty frugal and mindful about like not buying new cars and the usual trappings of life that you can fall into that turn into traps, and you get tied to all of these recurring expenses, and before you know it, you have to get a promotion just to afford your lifestyle. We've done a pretty good job of avoiding that. So as a result, our disposable income's growing a lot faster than our expenses, to the point that, and again, I don't want this to sound like a brag, but generally speaking, if either of us want something, we just can get it, right? But we don't want Maseratis, so that makes it easier,
right?
To get to this point. So for me, I went through that painfully hard lesson about money and the value of money versus the value of time and being responsible in my 20s, and came out the other side kind of ditching those money and feeling stuff, and really money as a tool, like learning how to think of it that way. I'll be honest with you, my wife, she's going to be okay with me saying this. She still deals with more of the emotional baggage of money. She came from a pretty tough, hard background, worked her ass off and leveraged her insane mind. Speaking of women who have to have some regret for poor decisions made at prior points in their life, to be immensely successful, and financial success has come along with that. But it's still a challenge that she deals with. Worries about bills, and do we have enough saved? And we've checked off all of like the short-term and long-term savings and all that kind of thing. So the conversations that we try to have are the things that we do in general, just to think about, mental health, talking through our money, regularly meeting, right, to talk about our finances. Long term, how are things? Are we making changes? Where are we on our goals? Do we need to back up the amount we're contributing? Do we need to ramp it up? Like all of those conversations, and then talking through the situation with bills and trips we're going to go on, and kind of bucketing the money aside for vacations. And it's healthy, regular conversations around those things go a long way towards kind of helping deal with that.
Yeah, totally agree. Being on the same page in terms of the way that I have found to get on the same page is to talk about like, what are the things we both want to do, and then prioritizing those things, right? And then not getting so much worried about the other stuff. The other thing,
and it's not about being on the same page on the balance sheet and the working capital. It's about being on the same emotional page,
right?
And maybe that doesn't mean you feel the same way about things, but you need to understand where your life and financial partner emotionally, where are they on these things, because then you can find the common ground.
The last thing I'll say about this, because I know Cena lives in New York City, and this is
he is poor because he lives in New York City.
Well, no, this is what I'm getting at. I think if you live in an expensive state or an expensive city, like I live in New Jersey, it's just an expensive place to live. There's this weird mind thing between, you look on paper at what you make, whatever that is, whether you think it's a lot or you think it's a little, and then you compare it to just your lifestyle. If you're a frugal person, not if you're like an extravagant person with $60,000 worth of credit card debt, but if you're just a person who lives within their means, there is this disconnect between like what you make and what it feels like it costs to live in your state. And
absolutely,
I think for me, that's part of it too. Like the whole, like, do you ever feel poor thing? Like intellectually, I'm like, no. But then I think about like, oh man, look at my property taxes, or oh man, look at my car insurance, or oh man, look how much it is to go out to dinner, So I think that might be a part of it too. But
that psychology is amazing, right? Because I think it's Morgan Housel and other people too. I think Ben Carlson's also written about it, where you can take like everything else equal, and if the average person you knew earned $50,000, and this was choice one. If the average person you knew earned $50,000, but your salary was $75,000, would you take that? Or if the average person you know earned $125, and would you take $100? And again, everything else in your life is the same. How much things cost is exactly the same as it is today in both of those scenarios. And a shockingly high percentage of people would take the less money that was worth more money than what other people made.
Hey everybody, we'll be right back, but first a word from our sponsors. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit-chat about investing every single week. From hot stocks such as NVIDIA and Celsius to hidden small-cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, Jason, next question we got from Alien Investor on Twitter, who asks you this question, Jason. So I'm going to just ask it and let you go. Alien Investor says, you own Bitcoin and also QuantumScape. Have you looked at the risks quantum computing may introduce to the Bitcoin network?
So I love this question for three reasons. Number one, QuantumScape has nothing to do with quantum computing, which Alien Investor absolutely knows, right? They're developing solid state batteries. But I love how it's like, hey, quantum computing's in the news. You own QuantumScape too. Let's make a weird question. So I love that. Number one. Number two, quantum computing is massively in the news right now. Number three, this is the thing that I love the most about it, is it's the reminder that, I can't remember the exact context of the entire statement, but risk is everything else, right? We account for everything we know, and then risk is everything else. And generally, disruption comes from places that essentially a rounding error from nobody really expects. And I think, Alien Investor, your point here with quantum computing, with Bitcoin's blockchain is massively secure, right? It's incredibly, incredibly secure. And that's one of the things that's helped it continue to be highly valued. There's the limited, the 21 million Bitcoins that'll ever exist. It's the OG, the brand, right, that has value, but it has value because it's super secure. So it's viewed as incredibly trusted, right, and unhackable, and all of those things that are viewed as a real positive. Now we're hearing in the news, I think it was the folks at Google.
Yeah, Google.
That just did something with a quantum computer where they solved essentially instantly a problem that it would have taken.
Wait, this is the best part. It took it like 5 minutes or 30 minutes, something like that, to do something that would have taken a non-quantum computer more time than has passed in the history of the universe to figure out.
Yeah. Yeah. It's pretty, that's good.
I heard a podcast where they tried to explain quantum computing, and look, I am certainly not the smartest man alive, but I also don't think I'm the dumbest. And I was like, smoke was coming out of my ears, just trying to like surface level understand what quantum computers can do.
Was it, I don't remember if it was Carl Sagan or whoever said it, but a sufficiently advanced technology can be indistinguishable from magic. It's magic as far as 99.997% of the people on the planet are concerned, right?
Yeah.
It is pretty remarkable. But it's impossible, right? It's highly improbable at this point, for quantum computing to exist in a meaningful way, because it's like a Ferrari that can go from 0 to 1,000 in 1 second, but it explodes, 7 out of every 8 times that you turn it on, right? It's so impossible to get it to actually work because you have to cool it to -460 to stabilize the components. And like somebody could fart in a bathroom in the building across the street from where the facility is, and the vibration could make it not work anymore. Right. It's incredibly finicky and difficult. So, do I think eventually, Innovation probably solves it. Probably. I mean, we continue to innovate just about everything else and make it better. So
yeah, I mean, if you had explained semiconductors to someone in the 1880s, that would have been just as magical as us thinking about quantum computing now.
They would have drowned you in a bathtub, called you a heretic. So eventually, yes, sure, maybe. But again, the point is that could quantum computing take these unhackable, unbreakable things and break them? Sure. I think that's absolutely the case that it possibly could, but I think it's also the kind of thing that would make so many other things better that I have financial exposure to. It's why you diversify, I guess, is the best answer. My cost basis of Bitcoin is, way under 1% of my portfolio. All of my crypto, it's like way under 1.1% of my portfolio, but it's, grown into a couple of percent of value because it's done really, really well. But so I reduced my exposure to the risks particularly on those kind of things that I don't really understand or have the capability to understand. But speaking of QuantumScape as a disruptor, there's a reason that I own very long dated calls on that business. I've got a small bit of exposure in the premium I paid for the calls for an outsized amount of upside if it works out. If it goes to zero and they don't actually do the things that I think that they're going to do on a commercial basis, the dollars that I've risked are exceptionally small.
Yeah.
Compared to if I bought anything close to an equal amount of the stock. But there's a massive amount of upside tied to it.
I think the only thing I'll say, because I don't know enough about this to say anything intelligent, which by the way is kind of like the theme of me speaking. I look at this as from a 30,000 foot view kind of perspective, that if you're ever questioning a thing, whether it's, can this be the next big thing, or will this disrupt this thing, or will this thing I own be disrupted? I always come back to, that's why reasonable amounts of that thing are the best way to go. And it's that, like you said, diversification, so here's an example as it relates to quantum computing. So my understanding is one of the things that could disrupt ASML, which is one of my highest conviction stocks. And they make the lithography machines that you have to make semiconductors. So you can't have modern technology without this company.
Yeah.
And
for the high end stuff.
Yeah. And what I understand is the thing that could disrupt that would be if we no longer need semiconductors, or at least their way of making them, because of quantum computing.
Yeah.
Cool. I know that's a risk. I'm not selling my ASML shares right now, but I don't know that I would make it an enormous position if I feel like quantum computing might actually happen sometime, right? So that's just one example, but that's kind of how I think of these questions generally. I don't think you ever have to stay out of something completely just because you are worried that it will be disrupted, or that it may have done all of the disruption it's going to do. It's just like position sizing and diversification is kind of a way to sleep at night when you're worried about that stuff.
It's also good to remember that it's incredibly rare that these sorts of things ever become binary. Quantum computing would certainly disrupt some of the highest end computing. I mean, I think the company that would probably be potentially the most disrupted would be somebody like NVIDIA, right? Mm-hmm. But we're not going to carry quantum computers around in our pockets. We're going to still have these, right? And ASML is still going to be pretty important for that, and TSMC is still going to be making those chips. So the disruption is rarely, again, it's so unknowable, but these things always start out going after the big things and then filtering down the commodity chain from there. So love the thought exercise though.
Yeah. It was a fun conversation. All right. Matthew J. Cohen asks on Twitter, to you, Jason, would you consider Lindy, ticker symbol LIN, a commodity business? So why don't you say what Lindy does? Because I've heard about this company a few times, but I can't say I know exactly what the business does.
Yeah, so this was a DM that Matt Cohen sent to me. Matt, thank you for sending it to me. I'm going to respond to you in DM as well. But the thing that I liked about this question is, if you think about Lindy's core business, it's an industrial gas company, and there's a handful of these companies, less than 5, that have, I don't know, like 80% of the global market share for industrial gases. You think about liquid oxygen, nitrogen, hydrogen. They do a big business in helium. I could just name an industrial gas, and Lindy's going to be right in the middle of it. And you would think, okay, these kind of sound like commodities, and they do trade. I mean, there's commodity exchanges for these that they trade on, and futures that can be bought, and supply and demand kind of move the needle. But these companies are very, very different in the way that they're structured, because they're manufacturers that plug directly into the input stream for their customers. So if you're I'm just going to throw a couple of examples out there. Let's say you're a steel producer and you need certain feedstocks from an industrial gas company. Chances are your steel mill is going to have pipes running from the industrial gas company to your facility. And there's not going to be a competitor on the other side of your building that's running in, and that you're competing back and forth on price with them. You sign a long-term contract with that provider. You do take or pay deals where you agree to certain minimums, and you're like a cornerstone customer from them. You get really good pricing. You get guaranteed consistent supply, because you can't turn this stuff on and off. You're running your facility. You have to have it at all times to run your facility and to manufacture your product, right? So they do that. You get a good deal because you're getting low costs coming directly to you, guaranteed supply, all that stuff. And then Lindy, whatever it is, let's say it's liquid oxygen, for example, in a couple 100-mile diameter area from that facility, they're going to send truckloads out to customers that are a little lower on the supply chain. They don't need as much volume, but they still need it. Their costs are a little bit higher. So they can leverage that facility off of those kind of cornerstone customers that they're piping to, and still sell additional capacity and supply that they have, and get better margins on that and meet demand. And then you have a geographical monopoly from your facility in that area, because you're not going to have a competitor try to come in. There's no reason for them to come in, right? Because they don't want to overlap with you. They're going to try to find a market, and because the industry's built up now, as we've seen industrialization happen, the market's kind of built up, and these companies, what they're able to do is grow a little bit faster than inflation generally, create value. They get operating leverage. So as they grow their revenues a little bit faster than inflation, more of the revenue goes to the bottom line, and their profits grow even faster. And they generate enormous returns on capital investments, enormous returns on their equity over the long term. And even though what they're dealing with might feel like a commodity, they're so value add in what they do. I don't think of them as commodity businesses. They're also very, very cycle resistant and recession resistant. Again, because even though the volumes might shift a little bit, their customers have to have this volume of this product to manufacture whatever they're making, and the fluctuations are a lot lower than you would think.
That's interesting. I don't know that. Like I said, I don't know much about Lindy, but might want to look into it a little bit more after hearing that.
You look at Lindy and Air Products, and a couple of other companies in that industry, and it's remarkable, like how expensive these stocks tend to stay all the time, yet continue to create value, because they're just so well run, so strong, so profitable, and so important.
Okay, so that's it for the questions we got this month, Jason. But we do have some comments that I just wanted to read because they're funny. So in response to the short video that you put up of me saying I was going to be wrong and you telling me I already was, Cunning Project on Instagram replied, "You guys are refreshing." So thank you, Cunning Project. We try to be refreshing. And in response to the video you made where you said you can't wait to hear my bad answers to our mailbag questions.
No. I didn't say bad answers. I said dumb answers.
I'm sorry.
Yeah,
I should be correct about that. The
dumb answers was my insults.
Well, in response to that, also on Instagram, Fearon01 wrote, "Jeff usually has smart answers, the whiz that he is." I agree.
That's fantastic.
So I had to read those. All right, I do have a spam comment of the month, but I'm going to save that because you let me know that in response to our live stream from last Friday, which anyone can listen to on their podcast feeds, the first Friday from December, one of the things we talked about was at the end was best and worst Christmas songs. And friend of the show, Colin, reached out to you because he had some thoughts, because we did ask for listeners to share their thoughts. So we're going to share them here on this episode.
Yeah, I love Colin from Canada. He's one of my favorites. No longer on social media. Luckily, we exchanged phone numbers at one point. So he texted these to me, sent me the White Buffalo Band's Christmas Eve, A Very Bros Christmas.
Wait, are these ones he thinks are good or bad?
Oh yeah, no, these are top of his list.
Okay,
top of his list. Yeah, his 3 top of the list. There's 2 songs on the playlist from there. It's Christmas Day, and of course, this is a classic. Dropkick Murphys, The Season's Upon Us.
Oh, all right.
Yeah.
Good. I'm glad he shared those. I don't know the first 2. I'm going to have to listen to them.
Yeah. So he says, this is interesting. So the Christmas Bros, Very Bros Christmas, that one, you look it up. It's actually a Saskatchewan band called the Sheepdogs. So.
Okay.
Yeah. Yeah. He said, you're not going to hear these on the radio. So love it. Love the obscure stuff.
Yeah, that's great. Okay, here it is, Jason, your spam comment of the month. We received this one on Twitter via DM, and it says...
As most of our spam comments are.
Yeah. Actually, you know
Thanks,
what?
Elon.
Most of them have been on YouTube recently, but I'm not even going to read them because they don't even make sense. They don't even sound like English.
No, they're all the same. They're computer generated and they're all the same.
Yeah. All right, so here's this one. Hello, Mr. John. I am Alaya, your financial management specialist. Your USDT account password has been retrieved. Sorry. Your USDT balance is 2,880,096, and then it also gives it in euros.
Oh wait, stop. That's this is real. That's not spam.
And then it gives the account and password and a link to click. And then it asks us to please keep it safe.
Well, that's good. I'm really glad they DM'd us that on Twitter, so we could be sure to keep it safe. Definitely the platform that prioritizes not spam and security.
It's really bad. It's so bad. I don't even
find us on Blue Sky, please.
Yeah.
Find us on Blue Sky.
Yes, please reach out to us on Blue
Yeah,
Sky.
we have 3 accounts. We have our own individual accounts. We have an account for the podcast too. Find us on Blue Sky.
So Jason, back in the day, we used to purposely plan a B section of the podcast, and we would put a little ad break in. And ironically, when we had that structure, it was before we really had any ads. So we would be like, all right, here's some ads, or maybe not. And then for most people, it would be like 3 seconds of silence and we would be right back.
Yep.
But we actually do have ads now, and we actually do have a second part of the show. So we can go back to the way we started, which was pretty professional.
Do the read. Do it.
All right. We have an exciting second part of the show for you. We're going to talk about our 2025 portfolio contest. But first, damn it, I screwed it up. But first, some words from our sponsors.
Hey, Jeff, I'll make us some coffee we can drink while the
no one wants the coffee transition.
Yeah, we're getting it. We're leaving the whole thing in.
All right, we'll be right back.
Hey, Jeff, how excited are you about the 2025 Investing Unscripted actual portfolio contest?
I'm excited about it because I think, as you mentioned earlier, having it be a portfolio contest and not a stock picking contest will make it more fun and interesting, but also it's simpler. Our first 2 years were at certain times convoluted to the point where I had forgotten the things we said. So this is going to be pretty straightforward. It should not take us long to explain. I will go through it and then you can tell me if I missed anything. So we're going to open this up to anyone listening who wants to play. And I'll talk about how you get your information to us in a second. But basically, everyone who plays in the portfolio contest is going to get 10,000 fake dollars. We can call them Smatterbucks, investing unscripted bucks. I don't know. We'll come up with some stupid name. And that's what you have to start with. And you can use it any way you want. All you have to do is before the market opens on January 2nd, 2025, because it's closed on the 1st, you have to send to us any way you want. Email's probably easiest for something like this. So investingunscripted@gmail.com. Just tell us the stocks you want and the amount that you want to invest in each of those. It just has to equal 10,000. It can be as many as you want. It can be as few as you want. It can be stocks. It can be ETFs. It could be crypto. I I would prefer it to be things that have like tickers, because then that's a lot easier for the spreadsheet for people to see. It's less work for us. So that's how we're all going to start off. 10,000 fake dollars, allocate it in any way that you want, send it to me, send it to the show prior to the opening of the market on January 2nd. That's step one. Here are the rules for the year. Every quarter, so each of the 4 quarters of the year, you can make 2 changes. Anytime in the quarter, but only 2 times, by just emailing us and saying, I'd like to swap this out for that, or add to this, or sell that, whatever it is.
Yeah. So again, to be clear, any 2 times a quarter, anytime during the quarter. So you got a stock that's skyrocketed. You think it's gotten overvalued. You want to exit. You've got something else you want to buy. You can do that. If you've gotten some insider information and you know a stock's going to fall, you can execute that sell before it falls, thereby alerting the entire market because of our global audience and releasing that insider information. So that we're not going to indemnify you if the feds come after you for doing that, people.
Not legal advice, as our friend Matt Levine would say.
There you go.
But here's the catch with the changes. You don't get any more cash.
Right.
You have your 10,000 for the year. So if you
invest $1,000 and it doubles and you sell that whole position, you have $2,000 to reinvest. If it falls by 50%, you have $500 to reinvest.
Exactly.
Yeah.
Now, the only exception to this is if something in your portfolio gets acquired, goes bankrupt, gets taken private, then you can immediately make a change to account for that. But that's
significant corporate event. You don't have to wait if a company stock goes up 50% because they're going to get acquired and they announce it in February, but the deal's not going to close to the end of the year. You don't have to wait. And that's an exception to the 2 free changes a quarter that you get.
Yeah. And the arbiter of all rules and questions will be us.
Yeah.
So, and because this doesn't really matter, we'll just make the decision we want to make. And the last piece of this is we're going to do the same thing we did for the past 2 years. We're going to announce quarterly winners and a year-end winner, and we're all going to give a charity to that winner, or we're all going to give to that winner's charity. So when you send us your picks, send us a charity you'd like to donate to. When we announce on the show who the quarterly winners are, we will encourage all of our listeners to give a little money to the charity of the person who wins. And it'll be our way to do a nice thing while we have some fun and have some new and interesting different conversations about these portfolios over the course of the year.
Yeah, that's just for the first year. We have a plan going forward too. And we'll talk about this more as the year goes through. But what we're initially thinking is once we get to the end of the year, if you want to continue participating in the contest, your portfolio carries over. New quarter, you can make a couple of changes. We might say maybe you can make even more changes. So let's say rebalancing. So maybe we'll say at the end of the year, if you want to rebalance across the holdings, maybe we'll allow that. Maybe we'll say you can make a couple more wholesale changes. We'll work on the details for that. But the idea is, again, we don't want this to be a stock picking contest. The idea is we want this to be thinking about long-term building of a portfolio. So if you're committed to do this, listeners, I'm looking at you, talking to you. You need to commit to do this for a lifetime, or at least the lifetime of this portfolio, this podcast, or until we decide we don't want to do the contest anymore.
Yeah. And last thing I'll say, even though this will be our new contest starting in January, we will continue to occasionally look back at both the 2024 and the 2023 portfolio contests and continue to have conversations as we see interesting things happen. It's already interesting to look back at the 23 contest and just see where things shake out now, almost 2 years into that one. And we'll do the same thing with the 24 portfolios as we move forward. Those spreadsheets will always live in our show notes, so you can go back and check them out at any time.
So you'll be hearing this on December 18th is when this episode is going to drop. So you'll have a couple of weeks to get your picks together, get your charity in order, and get those emailed to us. If you have any issues with emailing or there's a problem getting to us, you can DM us on all of our socials. We're pretty easy to get in touch with if you need to. You could get in touch with Sina Hasuna, who's so graciously volunteered. I'm kidding. Don't send Cena anything. He hasn't volunteered to do anything at all. But yeah, you'll have a couple weeks to get everything together. So I'm excited about this, especially the fact that we're going to continue talking about the 2023 portfolio contest because I'm up 182%. I think I think I'm doing so good that in aggregate, I think even with the losses I'm soaking up this year, I think I'm still the 2-year winner.
Well, as soon as Outset Medical turns it around, I'm going to...
That'll just help me too.
That's right. Because you have it in your 24 portfolio.
I do. See?
All right.
4D chess, buddy.
Yeah. 4D chess. Yep. More like 1D checkers with you.
Fair. That's fair. All right, Jeff. I think we did it.
We did it. We answered the questions. We responded to the comments. We talked about the contest. We did it.
All right. Stay tuned for more about that stuff. Get that stuff into us as quick as you can. We really look forward to having more fun with all of our listeners as we get into the next year and beyond. As always, these are our thoughts. These are our ideas. And especially on the mailbags, these are our answers. It's still up to you to figure out your own answers for the hard questions about investing and finance. I think you can do it. I believe in you. All right, friend. We'll see you next time.
See you next time.